Hello and welcome to the February 8th, 2010 video version of Invested Central's Chart of the Day. I'm Tom Bowley, Invested Central's Chief Market Strategist, and it's my pleasure to provide you with today's Chart of the Day. This Chart of the Day is brought to you by StockCharts.com, simply the web's best financial charts. Normally for our charts of the day we focus in on individual stocks, looking at either long or short candidates. Last week actually we had 4 consecutive short candidates that all did pretty well, especially the shorts that we had provided Tuesday through Thursday of last week. I think each of them had dropped about 10%. Today what we're going to focus on is the S&P 500, and the reason I want to do this is we had a short-term reversing candle that you can see here on Friday. Volume picked up, we had a nice reversal, long tail to the downside. Ordinarily, this is a very bullish candle in the near term, and it is, even in this case, a very bullish candle in the near term. You always like to see heavy volume reversals after a sell-off during the day. However, I'm somewhat cautious about the overall market, and I do think we could get a little bit of a bounce here, but I don't know that it's going to last, and I'm going to tell you why. First, there's some who might compare this move here to the move that we saw at the end of October, or even this move that we saw back down here at the end of June and into early July. You can see we made a move down, we bounced, and then we made a move lower, similar to what we've just done here: a move down, a bounce, and then a move lower. The problem that I have with that is when you take a look at this move back in June and July, the first move down was to the 50, we bounced, and then we went down below the 50. But notice the volume. The volume, it was not present on the move to the downside. So we didn't have any major price volume breakdowns, even though we did lose the 50-day moving average, and we did see what's referred to as a death cross, which is a short-term moving average crossing beneath the longer-term moving average. Had this had a lot of volume with it, I think that probably it would have been a much more bearish, would have had more bearish implications, and we may have seen some more selling after that. But instead what happened is the biggest volume was actually the day of the reversal, and then when we came back up through the 50-day and we had a golden cross where the short-term moving average then moves back above the longer-term moving average, this was accompanied by heavier volume. The initial move on the MACD below the center line turned right back up, and we went right back through the center line. So everything kind of remedied itself. October was just one quick move down and then right back up. We came through the 50. Now in this case, I think there's a couple things that are different. I want to point these out. First, the MACD, which went through the center line, on the latest recovery attempt, the MACD barely budged to the upside and then right back down. Momentum is with the sellers. That's what the MACD is telling us here. Also, the death cross. We have seen the 20-day cross back beneath the 50-day. That's never a good thing. The volume trends, as I indicated earlier, some of the weakness that we saw back in June and July, not accompanied by very heavy volume. Well, this is some of the heaviest volume that we've seen here on the loss of the 50-day. And then finally, the RSI, which usually has good support at around 50 on any pullback in a bull market. You can see we blew right through 50, went almost all the way down to 30, which is oversold, came back up, and we failed at 50. So this is indicative of more of a bear market type behavior on the RSI. So all of these things combined tell me that this reversing candle, yes, it could play out in the near term on a move to the upside, but I'd be careful if we get back up more than about 2 or 3%. I'm not sure we'll make that kind of move, because we do have some serious resistance up just above 1100, and we've now got this declining 20-day also sitting at 1100. So I think right now what we want to do is just be very careful in this market. If you're looking for some additional guidance, make sure you sign up for our Market Pulse newsletter. It comes out weekly, and you also get this chart of the day emailed directly to you. So I hope you've enjoyed this presentation today. Again, be sure to check out our chart of the day every day at InvestedCentral.com. While you're there, sign up for our free weekly Market Pulse newsletter and have the chart of the day emailed directly to you. Happy trading.